How's it going, guys? Last week, the stock market dropped pretty hard, and it's because investors think that the economy might start running a little hot, which is another way of saying we got stimmy checks and stimulus packages out the wahoo, Jerome Powell in the printer, we got interest rates low. It's all this expansionary monetary policy that is making money freely available in our pockets to be spent on goods and services, which means if we do that, it'll drive up demand for goods and services, which increases the prices for goods and services, which is an increase in inflation. So when people say that they think the economy is going to start running a little hot, it means that things are going to go too well and inflation could be a problem. Now, how do we know this is a general consensus? Is it because the stock market dropped? Did someone tweet about it? Did someone read it on a napkin at a bar? No. It's because bond yields spiked. What's a bond yield, Adam? Well, a bond yield is how much money you make from, say, a treasury bond. So if you buy a treasury bond for $900 and in 10 years, they'll pay you $1,000, that's a 10% return. That's a 10% yield. And if bond yields go up, that means that how much people pay for those bonds decreases. So if you maybe initially paid $900 for $1,000 10 years from now, that's a 10% yield. But maybe now people are paying $800 for $1,000 10 years from now, that's a 20% return. That's a 20% yield. So if people are paying less for the bond, yields go up. And this indicates an expectation of increase in inflation because treasury bonds are a great way to hedge against inflation. If you can get a return from treasury bonds that is higher than the inflation rate, great. You just saved your money from the decay that would occur over time through inflation. And they're a very safe investment. It's very unlikely that the United States government is going to default on you. But if there's an expectation that inflation is going to increase, those current yields may not be good enough to hedge against that inflation. So people start paying less for those treasury bonds to get higher yields so that they can actually more appropriately hedge against inflation. So when we saw the spike in treasury yields, it was an indicator that people thought inflation may be a problem in the near future. Now, is inflation necessarily bad for the stock market? Is that why the stock market dropped? Not necessarily. Runaway inflation is bad. You don't want that to happen. It can reduce the overall aggregate demand for goods and services and be a real bummer. But the real concern for the stock market investors is how the Federal Reserve responds to an increase in inflation. The main way the Federal Reserve System, Jerome Powell and all his little cronies, handle an increase in inflation is through manipulating interest rates. There are two primary interest rates that the Federal Reserve manipulates. The first one is the discount rate. The discount rate is the rate at which banks that we know and love, like Chase or US Bank, I actually hate US Bank, but banks that you know on the street, it's a rate at which they borrow from central banks, banks that are part of the Federal Reserve System that instigate monetary policy. So let's say the inflation rate does start going up. Well, the Federal Reserve, Jerome Powell and his boys will increase perhaps the discount rate. Then banks that use central banks as a lender of last resort, meaning if Chase has immediate liquidity needs that can't be met elsewhere, they can borrow from central banks. They have to borrow at this increased discount rate. So the money becomes more expensive to borrow. If it's more expensive to borrow, they have to pass that cost along to customers. Now, less customers are going to be able to afford to borrow money, which means there's going to be less money supply available in the economy, which means there's going to be less money spent on goods and services, which means demand has decreased and prices decreased, inflation has decreased. So when the Federal Reserve increases the discount rate, it becomes more expensive for banks to borrow through the discount window at the discount rate, and they have to pass that along to customers that no longer can borrow that money. So there's less money available overall, which decreases inflation. Right? This is contractionary monetary policy, which is contrary to the monetary policy we've been experiencing, these low interest rates, the stimulus packages and checks, all that jazz. So that's the first interest rate that can be manipulated. The second rate that the Fed can manipulate is the federal funds rate. That is the rate at which banks borrow between each other. And the Fed can manipulate this by, well, if they want to increase it, they will sell treasury bonds. If they sell treasury bonds to banks, banks will pay them money for those treasury bonds. They now have less money to loan out. People will now pay more to borrow money, higher interest rates. They now have less money to loan to each other, okay, because it's now in treasury bonds. So then they have to increase the rate at which they borrow between each other, which they have to pass along to the customer. And there's just less money overall and less people willing to borrow at higher rates. So less money being spent on goods and services, a decrease in demand, the same shebang. The Federal Reserve either selling treasury bonds as contractionary monetary policy to reduce the overall money supply, or buying bonds to increase the money supply, which is expansionary monetary policy. Those operations are called open market operations. So when they're doing contractionary monetary policy, okay, they are increasing interest rates overall, and banks have to pass those costs along to customers and mortgages and different loans. They increase interest rates. So everything becomes very expensive. This isn't good for companies because it means that people have less money to spend on their products. And it also makes it expensive for companies to borrow money from banks. It also means that people may start moving money from stocks over into bonds, which now have higher yields. So overall, it's not very great for companies. So that is why you see this drop in the stock prices. So you see this rotation out of very popular growth stocks into more like recovery plays into financials, energy, and retailers. But generally speaking, I think it's a little bit overblown because the Federal Reserve, specifically Jerome Powell, has maintained his dovish position, which means he's intending on keeping interest rates very low, close to zero, for the foreseeable future to keep the economy growing until it gets its foothold. So people getting spooked that there's going to be an increase in interest rates may not be super justified. It may also be an overestimation of inflation. It's possible to have some inflation as we get all this energy sparked back in the economy. But people have to also understand that it's not literally Jerome Powell printing money. It's usually just buying or selling treasury securities, which does not increase or decrease the overall monetary supply, the overall amount of dollar bills that are in existence. It just increases or decreases the amount available. And people also have to understand that it's not simply just more money equals more inflation. It's more complicated into that, which takes into account the velocity of money as well as like how many people are employed or unemployed and other factors. Okay, it's not just more money equals more inflation. And as far as I can tell, basically everybody who knows anything is saying that inflation is not going to be an issue in the near future. And with an expectation of a 5.5% increase in national GDP over the next year and continual reduction in unemployment, I think it's there's more to be happy about than sad about. So while the rotation out of very popular, possibly quite overvalued growth stocks into more recovery plays could continue to happen, especially as this $1.9 trillion stimulus bill gets passed, I don't think there's any concern that we're going to be heading into some deep, dark red bear territory. That's my personal opinion, how I see it. When I see red, I buy. Okay, I'm a simple man. And it's not surprising that at some point the Fed is going to increase interest rates. Okay, when you're down near zero, there's nowhere else to go. You're eventually going to have to increase interest rates as the economy expands so that you have ammo to do expansionary monetary policy when you're in a contractionary period of the business cycle. So probably some inflation, but I do not think it's going to be runaway inflation, especially because if it's runaway inflation, that generally means in our scenario that the economy is performing really, really good and could probably tolerate some increase in interest rates. Anyway, that's how I see the whole thing. If you guys have a different perspective or some thoughts on this, let me know. If I feel like I need to make a correction to anything I said, I'll just put it in the pinned comment. I love you guys. Buy the dip, I guess. Not financial advice. Have a good week.